Today, we will talk about high-ratio loans. A high-ratio loan is a loan whereby the loan value is high relative to the property value being used as collateral. For mortgages, a high-ratio loan usually means the loan value exceeds 80% of the property's value. The calculation is called the loan-to-value ratio, which is an assessment of lending risk that financial institutions use before approving a mortgage. Although there's no specific formula to calculate a high-ratio loan, investors should first calculate the loan-to-value ratio in their situation to determine if the loan exceeds the 80% LTV threshold. Lenders and financial providers use the LTV ratio to measure the level of risk associated with making a mortgage loan. If a borrower can't make a sizable down payment and as a result, the loan value approaches the value of the appraised value of the property, it'll be considered a high-ratio loan. The lender is at risk of borrower default, particularly if the LTV is too high. Most high-ratio home loans require some form of insurance coverage in order to protect the lender. Home loans used to be for half the value of the house or less, but by the 1920s, banks began making high-ratio loans of up to 80% of the value of the house. Private mortgage insurance came into being during this period to protect banks. Congress enacted the Homeowners Loan Corporation, which began guaranteeing mortgages and ratios sunk to 15%. This system continued until the 2008 mortgage crisis. The Federal Housing Administration offers programs through which borrowers can get FHA loans with an LTV ratio of up to 96.5%. There are other offers whereby a lower credit score is allowed with a 10% down payment. For example, say a borrower plans to buy a home with a $100,000 appraised value. The borrower can only afford to make a $10,000 down payment, and the remaining $90,000 will have to be borrowed. After approaching several lenders, one finally agrees to underwrite a mortgage with a higher-than-average interest rate, resulting in a loan-to-value ratio of 90%. A home equity loan is for those who already have a mortgage and want to borrow against the equity in their residence. A high-ratio loan has a loan value that approaches 100% of the property value. Here are 3 key takeaways. 1. A high-ratio loan is one where the loan's value is large relative to the property value being used as collateral. 2. A high-ratio loan usually means the loan-to-value, LTV, exceeds 80% of the property's value and may approach 100% or higher. 3. Mortgage loans that have high loan ratios can be quite risky and carry above-average interest rates. Hope this would help. Thanks for watching.